And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it's the second best day of the week. That means it's Thursday. That also means Michael Leibowitz is joining me this morning. We're going to talk all about AI and the future of electricity and power today. So we've got a lot of stuff to get into. Good news is Houston has now ranked number one in something. It's hard to come by, but Houston is now leading the pack. Now, I put this out on Twitter this morning, and of course, you know, other cities, you know, like Chicago, Baltimore, they lead in other areas. Houston, we're number one in foreclosures. So, yeah, out of all the cities surveyed, Houston, Sugar Land, Woodlands, all the surrounding suburbs of Houston are leading the nation in home foreclosures right now. So a very big uptick in that. So again, you know, we keep talking about this kind of, you know, housing problem that we have. And, you know, one thing about, you know, higher rates is, and again, talking about inflation, higher rates, higher cost to borrowers, et cetera. Ultimately, it gets, you know, you can cut back on other stuff, but eventually, you know, if you can't pay your mortgage, it leads to foreclosure. So we are seeing a big uptick in foreclosures. We're also seeing an uptick in delinquencies as well and when we talk about delinquencies, we're talking about serious delinquencies, 90 plus days. Delinquencies on both credit cards as well as auto loans. So certainly seeing the impact of that starting to show up in the economic data. Now, it hasn't shown up yet to a great degree in consumer spending. Now, today and tomorrow, we've got a lot of data coming out on GDP, first quarter estimate. First estimate for the first quarter. Also, we will get PCE coming out, which is personal consumption expenditures. We'll get the price index, so we'll see that. Now, retail sales have been fairly strong. We've gone through that data and suggested that maybe it's not quite as strong as headlines suggest, but the data that's coming in still suggests that the economy's firing on all cylinders. The economy's doing fine, it appears. Employment continues to be okay. So again, though, we have this anecdotal evidence that's sitting out there, rising consumer delinquency rates, foreclosures on homes. These types of things suggest that the consumer may not be as well off as a lot of this government headline data suggests. Now, again, so far, you know, as this relates back to the economy, earnings for the S&P 500, as an example, continue to outpace the growth of the economy. Now, that can last sometimes, that can happen. And particularly after you come out of a period where you had slower earnings growth like we had back in 2022, coming out of that, the revision of that growth can be fairly strong. And we've seen that. But estimates now are projected to be just astronomically higher going into 2025. In fact, the deviation from the long-term growth trend of earnings is now the highest on record going back to 1950. So we've got this very big gap between what the economy can generate in earnings and what we're seeing in some of this headline data, like home foreclosures, and where companies actually generate the revenue. Now remember, earnings have to come from somewhere. The earnings just can't magically appear. They have to come from revenue. Revenue comes from sales. Where do sales come from? Well, that's the consumer. So again, we'll see. And again, we've heard some anecdotal evidence of this from companies like Walmart, Target, McDonald's, Starbucks have all talked about weaker consumer spending. Now, again, we haven't seen it shown up in some of the economic data yet. That hasn't translated into the markets yet, but it seems that this deviation between what, the headline data suggests. And of course, this also is the underlying driver of inflation, because as we talked about yesterday, inflation is a function of supply and demand. So again, if you're expecting higher rates of inflation, that becomes problematic when you see some of this data that's coming in, like home foreclosures, like Walmart, like Target, et cetera, in terms of retail sales, consumer sales, et cetera. Because again, that's supply and demand. And yesterday the Beige book came out. So this is a report that is from the Federal Reserve, and it surveys businesses. And the one thing that was noted, so inflation is not a big concern in this report. So again, if you take a look at the number of mentions of inflation, that's been falling fairly sharply along with the rate of inflation, right? So inflation's down from 9 to 3, and the number of mentions of inflation have dropped sharply. The one thing that's picking up, though, is consumer demand is weakening. So we're now seeing this from the actual producers of goods and services in the economy. And again, this kind of goes to our conversation yesterday. We talked about, corporate, this idea that corporate greed is causing inflation, and that's not the fact. Corporations simply respond to inflation. So we're seeing more and more of this data just continue to stack up to suggest the economy is actually likely much weaker than what headlines suggest. So again, it hasn't translated into the markets yet. It will eventually. And again, this is one of the things that we've got to keep paying attention to. And as we go forward, yes, the Fed's not going to cut rates now, but if the economy weakens enough later on this year, they will cut rates to try to stave off a slide into a negative growth rate environment. That's the one thing that they don't want, right? They don't want that disinflationary pressure in the economy. So let's talk a little bit about the markets. We're going to look at some interesting charts this morning. So again, the S&P, as we talked about yesterday, excuse me, hasn't really gone anywhere for about 2 weeks now. We just consolidated sideways. Nothing really exciting going on with the markets. The one thing to pay attention to is that we will trigger today. So the markets are expected to open down this morning. S&P's down about 19 points right now for the open. Excuse me. If we do crack today and we don't recover, if the market's in negatively today, we will trigger this MACD sell signal. That suggests that we're likely going to continue to get some weaker pricing in the markets over the next week or so. Again, this 20-day moving average has risen now. It's sitting right below the market. So again, there's some initial support even on today's decline. This is going to be a test of the 20-day. The question will be whether or not the market can hold that 20-day like it did previously when we were having this rally at the beginning of the year. We just ran right along that 20-day moving average. So this will be the first test of the 20-day moving average here to see if that provides that initial support for the overall market. The one thing that again, we kind of look at is other risk assets, risk-based, assets that really kind of focus on risk. Again, we're working off this overbought condition on the S&P, which that's good. But the sell signal may prove a little bit problematic here short term for higher prices. But if we look at other risk assets as well, again, lots of, when you talk about pure risk, that's Bitcoin and, cryptocurrencies in general. So this is really a momentum-based trade. Generally has very high correlation relative to the S&P. We had a very nice rally over the last couple of weeks with the S&P. So again, as the S&P was rallying, it was risk on. Bitcoin is a great risk on asset for a measure. It's also beginning to weaken, triggering a sell signal along with the S&P. So again, you're starting to see these kind of correlations between these assets. Here's Ethereum. Ethereum just got a big pop a couple of days ago because of the expected approval of ETFs by the SEC for Ethereum. That is very likely that will happen, right? So everybody's kind of waiting for the ETFs to get issued. But again, it's getting ready. It's starting to roll over here, getting close to triggering a sell signal. Not as close as Bitcoin, but starting to work in that direction as well. So when you start looking at other risk on assets, we're seeing that kind of same environment. Crude oil as well. If I get it, there we go. Crude oil, there we go. Thank you. Crude oil's been bottoming here as well. So again, it's already had a big correction, and again, kind of economically sensitive across the board is oil. Again, but it's coming up on a little bit of a buy signal. So we may see a little bit of buying moving into oil prices here in the short term just because of this kind of oversold condition. We'll see. But again, take a look at risk on assets across the board. They're starting to show that signal that we may see a little bit more weakness in the market before we get another rally. Okay, that's what you need to know before the bell this morning. We'll come back, pick up with a whole bunch of stuff about AI and power this morning with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, kind of a lot of things kind of going on. And again, one of the big topics as of late is, of course, what's going on with artificial intelligence. And again, if you take a look at hedge funds as an example, they are very, very long semiconductors. In fact, they've got the highest level of semiconductor exposure on record for hedge funds. Take a look at their exposure to AI-related stocks. That's a very high level of their allocations as well. They're, kind of in the Mag 7 for the most part. That's what's been driving the markets. We've talked about that before. If you take a look at the S&P versus the S&P equal weight, which balances out that weight of those top 10 stocks, that deviation in performance is one of the largest on record as well. So again, this has become a much more narrow market overall. And again, it's all about the AI themed chase as of late. And again, this is, everything we're talking about here as of late has been, AI related. Well, there's certainly some concerns about it. In fact, there's an article in the Wall Street Journal this morning says the record stock market is riding on questionable AI assumptions. And it says, basically, the headline says just 4 giant technology stocks added more market value than the rest of the S&P 500 put together just this month. Of course, Nvidia is the leader of that pack. More than half that gain came from Nvidia. So, so again, it's all about AI at the moment. Again, if you've lived through this market long enough, Mike and I, lived through the markets in 99, 2000, we saw the whole .com, rally and bust eventually. There is a big difference. I don't want to say that this is another .com bubble because there's a huge difference. The difference is these companies actually make a ton of money. We have a word for that in Texas called a beep ton of money, but there's still FCC regulations. But companies make just a ton of money today. Their revenues are strong. Back in 1999, a lot of these companies had no business model, no earnings. They just stick a .com name on something and people would run up the stock price. So there's a massive difference between the companies that we're talking about today versus the companies we were talking about then. But there is the reality that things can't just go up forever. Again, there's a rationale between the price that you pay for something and what things can actually generate. And so again, we're very early in this cycle, and it can last a whole lot longer than you can ever imagine. I'm getting a lot of emails now. It's like, well, trees don't go to the sky, and that's true, they don't. But we're very early in the cycle, and these cycles can last a lot longer and go a lot further than you would ever logically think possible. They will eventually correct. We will see, these stocks have a significant correction at some point to realign valuations with the reality. We just don't know what reality is at the moment. We don't know what the future of AI looks like in terms of job creation, productivity, et cetera. I will tell you, and Mike will remember this, and I'm going to bring Mike here in just a second. But back in late 1999, and Brent and I, when we first started working together in 2000, we were seeing kids graduate college, and they were getting job offers for $350,000 a year. They get a new Mercedes, whatever it was as a signing bonus, to get them to come build websites, because there was a dearth of people that had the ability to build websites back then. We're seeing the same thing today. If you get an AI specific degree thing, there are job offers right now for $350,000. A lot of because there is not enough of those people right now to fill the demand. And as we talked about yesterday with inflation, it's supply and demand, right? Now, eventually, everybody's going to go get an AI degree in something, and we'll have a huge surplus of people. And those same jobs that back in 1999 were paying $350,000 a year for, those are $40,000, $50,000 a year jobs now, right? Because everybody can program a website. So, that's going to be the eventual evolution of this. But again, it's important to understand that AI does have some limits, and part of this will be driven by supply and demand. It will impact productivity, et cetera. So, what does all this have to do with Mike's latest article? So we've got a whole series of articles that are coming out. I've got one out tomorrow on this as well, talking about the side benefits of AI. There are other things that are coming that will be a byproduct of AI. So, there's an old saying about, don't buy the gold, buy the gold miners, right? It's buy the guys that sell the pick and shovels, because they're the guys that are going to make money versus the price of gold. So again, that's the old thesis. Well, what are some of those areas? And so, Mike, you've been working on this, this part 2 of 3 this week that we're working on?
Part 2 of, I'm pretty sure it will be 3. I got it down to 3. I was scared it was going to be 4 for a while, but I narrowed it down yesterday.
Okay, well, if you're just going to be lazy, that's okay. But yeah, I mean, so, kind of what's the general premise you're working on, and let's just take it from there.
Well, the general premise is Nvidia, right? 80%. If you look at Nvidia's stock is going to the moon, but so are their earnings and revenues. And it doesn't seem to matter how high estimates are. Every quarter, when they release their earnings, they beat them handily. And then they revise upward their earnings and revenue forecast for the coming quarters. And it's just startling how much the stock is going up, but how quickly its earnings and revenues are going up as well. So what's driving their revenue? And roughly 80% of it, 75% of it is coming from data center GPUs or chips that are basically used to run these massive data centers that basically do the AI computing. And just to give you a little feel for AI computing, when you run a Google search, when you run an AI, like a ChatGPT search, a search using AI, it uses roughly 8 times the power as just a normal Google search. And the amount of power that and number of chips and data centers that they need to run these millions and millions of applications of AI are just tremendous. So what's going to happen, and what is happening already, is that the world, the United States, needs a lot more data centers, and they're being built pretty quickly. And they're being built pretty quickly. So we kind of take this AI narrative to the next level. Okay, we're going to have data centers. How do those data centers get their power? Who's going to power the grid, essentially? And so I really focus on the power grid itself, because it's not even just AI. It's also electric vehicles and how much power, electric power, they use. So, our economy, as it continues to mature with AI, with other innovations like electric vehicles, or even our cell phones and all these other things that we have, use electricity. So our need, or the utilities need to generate more and more electricity, is going to become in greater demand as we go forward. So that's where I kind of started my analysis. Is part one is just simply how much electricity are we going to need? What's the deal with AI? What's the deal with electric vehicles? And then, as my first part, which came out yesterday, starts digging into how do they actually get more power going, and which companies and industries will benefit most from that.
So, yeah, there's also another, kind of an issue with this, and something that I think we kind of touch on in, kind of the next section, the next segment of our show this morning, is, when you start talking about the demand that they require, that's utilities, that's energy production, et cetera. But then there's also another side effect of this, which is productivity. And, one of the things that AI will do, and more so to a degree, we saw this during the dot-com bubble. This was the whole idea with the internet, is that it was going to make things, much more efficient. People were going to be much more productive. And, the story was back then is like, well, yeah, if you lose your job because of the internet, that's okay, because now you can go do something with the internet, right? And so that was the idea, is that we would shift all this productivity towards the internet, and it would just create all these new jobs, which, it did to a degree. But, we can take a look at labor productivity. We can take a look at wages. We can take a look at, lifestyle efficiencies, et cetera. And there's been a steady decline in economic prosperity. So the more efficient that we get through productivity advances, the less economically benefiting it seems to be. And that seems to be maybe what might be the case with AI as well.
Yeah, I mean, I guess we'll find out. We may not find out for 20 years, like with the internet,
right?
But we'll find out exactly how productive it really is.
Well, and I mean, it is productive, right? But again, if AI, replaces 4 lawyers, because I don't need research lawyers anymore, right? I just tell AI to go get me all the case law. If it replaces nurses and doctors, because I don't need as many to do the analysis, because AI can do that work, for that. I mean, we're talking about replacing jobs that are much higher, productivity-wise in terms of the economy than what the internet was ever capable to do, because AI is very different in the very basics that it can do. Engineering, it can do legal work, it can do accounting, it can do all these jobs that we thought were protected. They're not protected anymore. So we'll come back and we'll talk about that, but also how there's actually a very positive side benefit to AI that may reduce our debt problem as well. So we'll talk about that right after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife's been traveling. She came back yesterday, so I made sure that I cleaned the house. I did the dishes, I did the laundry, went to the grocery store, I bought her favorite groceries, put them in the fridge. So I thought I'd done a really good job prepping everything for her return.
The Real Investment Show podcast.
And then I get her home. She flips on the Roomba. She gets out cleaning solutions. She starts cleaning stuff. And I'm like, can't win.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, Mike, as we're talking about, before, when you start talking about artificial intelligence, one of the byproducts of that is it requires a tremendous amount of power and water. The question is where is that going to come from? The problem with solar and with wind is it's not efficient. You can't produce enough power with it as much as you can with either natural gas or with nuclear energy, et cetera, which there's going to have to be more of a move in that direction to, not only just provide the power requirements for artificial intelligence, but also just the increasing power requirements of the population, whether it's electric cars and phones and computers and everything else that we're doing that all requires energy, not to mention powering your house. The demand for energy is going to keep increasing. And the other problem is we haven't upgraded our electric grid in 30 years.
Right. Right. That's a huge part of this, is that the electrical grid, the power grid, is antiquated in many places. So it's not just that we need to expand them, but we need to upgrade them. And again, so the number of opportunities for companies to profit from the production of more energy, of cleaner energy, of more efficient energy, is just tremendous. So in the part two, which just came out yesterday, I started tackling all these things, and I pretty much got through traditional energy sources. Part 3 talks about alternative energy sources, and then a host of other companies that are involved in the build out, the monitoring of utilities, etc. So part 2, which just came out, focuses on natural gas and nuclear. And it does address, a reader had a question for us after reading part 1. They said, what about Bitcoin mining? And Bitcoin mining, believe it or not, is a big deal. It takes up a little bit under 2% of our electricity generation. Now, it's not enough to cause the expansion of the power grid, but 2% is a lot, especially for something that is, and this may upset a few listeners, very unproductive. It's not clear there's any true economic benefit from mining Bitcoin, whereas AI data centers will create economic upside. So we provide a few stats on Bitcoin. Then we talk about natural gas. And, one of the questions is, well, if I think they're going to produce a lot more electricity, maybe I should buy a natural gas company. That's fine. What do? Do you buy an upstream company? Those are the companies that are actually pulling the nat gas out of the ground. Do I buy a midstream company? Those are the ones that transport it. And I go through the pros and cons of each. But at the end of the day, I kind of come to the conclusion that natural gas is going to greatly benefit because, we're trying to get rid of coal. Nuclear is great, and I'll talk about that in a second. And alternative energy sources are also nice, but they're very flawed. So natural gas, at least for the next 4 or 5 years, is likely to be one of the bigger winners. And the problem with natural gas producers is that there's a lot of natural gas. So even though the demand for natural gas may go up, it doesn't mean the price will necessarily go up. If estimates for the amount of natural gas reserves are correct, there may be enough natural gas to handle all this demand. So the price of natural gas can, somewhat stagnate where it is, which is at, more or less the lows that it's seen in the last 30, 40 years. Doesn't mean there can't be spikes, especially around seasonal events. But that's one concern with the natural gas producers. Midstream companies are the pipelines. They're basically toll takers. The gas flows through their pipelines, and they have a little meter on a pipeline, and every time gas goes through it, they basically charge a toll, just like the number of wheels on your car when you go through or a truck when you go through a toll booth. So it was kind of my conclusion that the midstream companies, especially those that are kind of solely focused on natural gas, have the most to win from this, as there's just going to be a lot more gas going through their pipelines, and their stock prices are much less dependent on the price of natural gas. We show actually a graph. The natural gas producers have a very high correlation to the price of natural gas, whereas the midstream companies do have a correlation. It's positively correlated, but much less so. So then we go on to nuclear. And, the problem with nuclear is it's clean. It's one of the cleanest energy sources. I know there have been problems, Fukushima, Chernobyl, but it's one of the safest energy sources. The problem is it can take 10 years or longer to build a nuclear plant. So even if we decide we're going to go nuclear, that change is not going to take effect for a long time. So when you think about, well, maybe I should buy uranium miners, that's great. But again, the need for that uranium is, it's certainly growing today, but some of that need may not be for 5 or 10 years. And, we go into who builds nuclear plants, who monitors them, et cetera. So, within this part 2, we spend pretty much the whole time on nuclear and natural gas as the traditional energy sources. And next week, we'll tackle alternative energy, which has plenty of pros, but plenty of cons. But with those cons come opportunity. How do we diminish those cons? So, there are ways to to benefit from these renewable sources in a more efficient way than we are now. And that may create a ton of opportunities for certain companies as well.
So there's another byproduct of this, though, that's important, because in order to provide all that energy, it's going to require a lot of productive investment. And, one of the big concerns that, people have right now is the level of, we're issuing all this debt and we have these interest payments that we've got to make. And, this is, one of the kind of the big overriding concerns of kind of the end of America as a democracy, et cetera, is the debt, right? One of the byproducts of this, though, is that build out of that power grid is a very different structure than using debt to pay for social welfare, et cetera, because these are productive investments that provide very long-term revenue streams back to the country. So in other words, this is very akin to what we saw coming out of the Depression, where we were building the Hoover Dam, where we were building the Tennessee River Valley Authority. Creates jobs, creates economic activity, demand for commodities, et cetera, but also provides a long-term revenue stream. Even if after it's built, you're still, the consumers are now paying fees for access to that electricity and that usage, which provides a long-term economic benefit. So, this would be one of the areas that not only does private investment pile in this, BlackRock is already well into the infrastructure build-out side of the investment scheme, but the government will also get involved in this, providing infrastructure packages, et cetera, to support the build-out of utilities once utilities have to start building out these things. Again, you can't build a nuclear power plant without government regulation and approval. So there's certainly going to be a joint relationship between the government as well as private equity building out this infrastructure for the economy. It's going to create jobs, create a lot of growth. And again, we start looking at debt to GDP. We're running about 120% of debt to GDP. If you do the projections, even using the current run rate of debt issuance that we're doing now over just the last 2 years, just assume we keep issuing debt at that same pace, our debt to GDP will fall to around 100% of debt to GDP by 2030. So it can happen very, very quickly.
Yeah, the Hoover Dam is such a good example. So at the time, they built the dam in the middle of the basically desert. There was nothing there. There was very little there. And they employed a ton of people. Those people worked, they became productive, but that was sort of a handout. But the benefit of building the Hoover Dam is the Southwest developed to a degree that never would have been possible had they not built the Hoover Dam. And to this day, cities like Phoenix, Las Vegas, and a whole host of other cities would not nearly be as big as they would have been without the Hoover Dam or with the Hoover Dam. So, think about all the tax revenue that the government is getting from those cities. Think about all the GDP that comes out of those cities. So even though the Hoover Dam was built, 90 years ago or whatever it was, it's still paying massive dividends to the government. So that is one of the, unfortunately, rare examples of where government is basically spending for productive purposes. And I think you're right, Lance, that this AI spending that the government will do, that they've already committed to in part, and a lot of municipals too will help the utilities expand their power plants, has the potential to be very productive and to, at the end of the day, not only pay off the debt that was used to do it by the government, but result in actual more revenue for the government than they spent. So, government turning a profit, so to speak, which is not something we talk about much.
It isn't. And this
surpluses.
And this, I don't know if we're going to get to a surplus anytime soon, but, it's certainly very beneficial. And, there's certainly going to be a ton of private equity money that's going to pile into this. Like I said, BlackRock has already been to Texas, has already been soliciting the state of Texas for infrastructure investment, et cetera. So it's coming. The only question is, how much will it be and how fast will it occur? That's going to be the other side of this. All right, when we come back from the break, got some economic data that's coming out today as well as tomorrow that is going to be all about the inflation debate. So we'll talk about that with Mike right after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So, got a good bit of economic data coming out today. We have the second estimate of the first quarter's GDP. That was the original estimate was 1.6, expected to be 1.3 this morning. So we'll see what that kind of comes in yet. It's kind of no telling where that's going to show up. But one thing is notable is that the economic growth rate is declining. If we go back to third quarter of last year, we were at 4.9. Then we went to 3.6, I think, in fourth quarter. I've slept since then. Now we're down to 1.6, 1.3, depending on where it is. So the growth rate of the economy is definitely slowing. If you take a look at nominal GDP, it's declining, fairly sharply at this point. So again, we are starting to see that impact of slower economic growth. And as I was talking about this morning, rising delinquency rates on credit cards, auto loans, foreclosures on homes, etc., all certainly suggest that the economy is not banging out, on all 8 cylinders right now. So again, it's just, we're certainly seeing some of that internal deterioration occurring. The other side of that, of course, is that, what does this mean for inflation? And, lately we've seen interest rates ticking up over the last couple of days, kind of anticipation of what PCE might be. We're going to get personal consumption expenditure prices, both core and headline. That's coming out as well. So what does that mean for the Fed? Again, this is all back to, honestly, just what the Fed's going to do. It's not really about the economy or anything else. It's just whether or not the Fed will cut rates. Of course, this will be the next big data point for the Fed because the Fed does look at the trimmed mean PCE as kind of their core reading measure of inflation. So they don't really look at CPI. They do look at CPI, but it's not their big consideration. Trim mean PCE is. And that is something we'll have out today. So, Mike, what do you think? Certainly seeing some deterioration in the economy. There's, certainly, but there's kind of continuing concerns about rising commodity prices are going to lead to higher inflation. What do you think?
So the Beige book also came out yesterday, and the Beige book is just a summary of all the Fed districts' economic activity, and it was weaker in general. It's hard to say weaker because you have 12 of these the Fed districts all providing opinions on what the economy is doing in their districts. But in general, it appeared weaker than it was at the prior release of the Beige book. So the economy is definitely slowing. The question is it, is this still all part of the normalization process, or is it slowing on its way to a recession? And I continue to the key focus has to be on employment, because at the end of the day, that's what drives the economy is employment. And that's one of the few economic sectors that there have been certainly some signs, some divergences in data. Like we've talked about a lot of them, full-time jobs are shrinking while part-time jobs are rising. The jobs that we're adding to the economy are in hospitality and restaurants and sectors that are very low paying, while the higher paying sectors are losing jobs. So there are certainly signs of weakness, but in the big labor numbers that we get, there really hasn't been that much of a decline. So that's where I'm focused on. Inflation is always a tricky one. I've said this a million times. You can't compute inflation. It's such an impossible number to calculate. And then the fact that we try to put a number on it to a decimal point, and if it's off by 1/10 of a decimal point, the markets go crazy and the Fed changes their outlook for what they will do or won't do. It's just kind of bizarre. And this is, they post this, like CPI, for instance, 2 weeks after or less than 2 weeks after the month ends. So it's based on not even real data. Some of it's real data, but some of it is just surveys, and some of it is extrapolating where data's been. And so what's PCE prices going to do tomorrow? I don't know. It could be 1/10 below estimates. It could be 1/10 above estimates. But the fact that the market will make a big move and the Fed may change their stance based on 1/10 of a percent on a number that probably will be revised is kind of crazy to me. We actually, in a commentary last week, I forgot which day, we wrote about there's been a whole host of economic data revisions, and they predominantly have been revising data lower. And that's part of the problem with, if we are slowing down, we should expect to see more revisions lower. So PCE may come in, they're expecting right now for it to be up 0.2% on a monthly basis, could come in at plus 0.3%. Next month, we find out they've revised it to plus 0.1%, and the market won't care. It will have moved on by a month from now. So, we have to be careful with our expectations and understand what we're trying to forecast is something that's extremely hard to forecast with very limited data. Over time, that data becomes available and it becomes much easier to calculate whatever it is you're trying to calculate. But, the market is driven on these data points. We obviously have to follow them. We have to appreciate what the Fed thinks they will or won't do, which data points matter most to them. And PCE prices is, according to them, their most important inflation indicator, and that will come out tomorrow.
Yeah, and we do have personal consumption. So we have today, like I said, the first quarter estimate GDP. We also have personal consumption expenditures today, and then tomorrow is the personal income month over month. So we're going to get a lot of data over the next day or two that'll tell us a lot kind of about where the economy is, where it's headed. But again, to your point, we've become so sensitive now because it's not really a discussion about inflation. It's not really a discussion about, anything other than just what's the Fed going to do and how's that going to affect the market. Will they cut rates? Won't they cut rates? And again, the bet continues to be the Fed's going to cut rates. So we continue to run asset prices up higher based on Fed rate cuts. And then as soon as the data's off by 1/10, higher or whatever it is, then, we're making these dramatic changes to, positions and portfolios, et cetera, in anticipation of, well, what does this mean now? And so we're trying to extrapolate, this data into the future that we don't really have any handle on whatsoever.
Right. And it's also, when you get these 1/10 differences, it can just be one sort of obscure item that just jumped in price or fell in price that can really skew this data. So, it's not even the whole number. It's the fact that one piece of data, for whatever reason, whether it actually prices went up or down, or there's just a seasonal factor, or the fact that Easter fell in March versus April, can skew all this data. And, it's incredibly difficult to forecast. And we probably will be shocked by one of these data points coming out today or tomorrow. And also GDP, the deflator. So the prices, the inflation they use to get real GDP from nominal GDP we'll get the second revision of that today as well.
Right.
And to some degree, people will look at that, although again, it's first quarter. There's not going to be too many people looking at it.
Yeah, well, I mean, it's like durable goods, right? I mean, we keep getting these durable goods numbers, and it's like, oh wow, the durable goods numbers are doing great, and then you look at the prior months, and they keep revising them lower and lower and lower, and again, this goes back to that whole conversation that you and I were having. There is definite evidence that the economy is slowing down, and maybe actually slowing down more than a lot of this headline data suggests. And we won't find out until we get, revisions a year from now. They'll come back and revise all this data next year and say, oh yeah, well, GDP really wasn't 1.6, it was actually 0.5, right? But again, we don't really look at revisions in terms of the market. The market will be off to looking at something else. And what's amazing to me though is how aggressively optimistic Wall Street is on earnings. If you take a look at the earnings estimates going out into the end of next year, Morgan Stanley's, predicting earnings per share are going to be up almost 30% from where they are now on a trailing basis. So, I mean, it's just a very aggressive thought process that earnings are just going to grow exponentially. And look, I know we can do buybacks to help boost those earnings per share, but you're talking about doing a hell of a lot of buybacks based on, economic growth rates where they are now. Right. There just seems to be a fairly big disconnect between Wall Street and what the economy is actually doing right now.
Well, so the question is, when we look at CPI, or the Fed looks at CPI, they use core, so they exclude food and energy. When we look at earnings now, are we going to exclude? Can we do earnings and earnings ex Nvidia?
Yeah. Well, no, that's
because if it all comes from one company, how beneficial is it?
Well, that's right. Well, no, then that's a fair point. And if you we've done that study, right? I mean,
right. Yeah.
We've put out charts where if you take a look at earnings growth ex the top 7 companies, there is no earnings growth for the S&P. The bottom 490 stocks aren't growing earnings, just 10, right? And really, how healthy and how beneficial is that to the overall stock market as well in terms of investing? And again, you take a look at hedge funds and mutual fund managers, et cetera, even us, we've got a heavy weighting in those top 7 stocks because you got to have performance or you don't have clients, right? And so the market is literally forcing more and more people into just 7 stocks in the index. How this ends?
Well, to be fair, that's where the earnings are too.
Well,
it's not just that they're the best performers, they're the best earnings companies.
This weekend's newsletter is the flip side of momentum. So we're going to talk a little bit about momentum trading, momentum investing, and why you have to be careful of that in the future. All right. That'll be in this weekend's newsletter on the website, realinvestmentadvice.com. Mike, thank you so much. Be sure and like and subscribe to the channel. We appreciate it. Danny will be here tomorrow for Financial Fitness Friday. Y'all have a great weekend.